Hello and welcome to our conversation on the financial reporting. In this session, we will try to take an example and understand the financial decisions of an online home needs supplier and called ABC Limited. And this was started by three promoters, A, B, and C, in the year 2018, with each one contributing a capital of 100,000. They started supplying all home needs through a mobile application which is hosted on a local server. As can be seen from their Excel, the balance sheet, the, the company is doing well as reflected by the retained profit, and the equity of the company has been increasing, has increased from 15,000 1.5 million to 2.4 million in a period of 2 years. Now, with this, they are planning to expand the business, and the transactions during the year 2019-20 are given here under. And it is required for us to convert these transactions into financial statements and examine the impact on the book value per share at the end of the year. So the first transaction the company did in 2019-20 is the purchase stock of goods for 250,000 on credit. Purchase stock of goods for 250,000 on credit. So these creditors will increase and the stock will increase to the extent of 250,000. Made a rights issue, the company raised further capital, by making a rights issue to the existing shareholders at the book value per share as on 31st March 2019. So the rights issue 10,000 shares at the book value as on 31st March. So the book value is equal to equity divided by the number of shares, and equity is equal to capital plus retained profit plus share premium divided by number of shares, which is 60,000, which is capital divided by the face value. So therefore, the book value per share is 41.66. So the rights issue was made at 41.66, and the premium is 31.66. So as per the accounting requirement, the capital is always shown at the face value. The capital is shown at the face value, and the excess money collected is shown as a share premium. So the capital will increase to the extent of the face value of the shares, and share premium will increase to the extent of the share premium raised during this rights issue. So the rights issue increased the capital and the share premium to the extent of the face value and the share premium. And here the shares were issued at the book value per share as on 31st March 2019. Then the company sold entire stock. For 20 lakh, 2 million for cash. So therefore, sales is equal to 22 million, 2 million, 20 lakh. And this is for cash received. And because of the matching principle, there has to be cost of goods sold. As a result, the stock will become zero. Stock will become zero because entire stock has been sold. Then they paid during this period a monthly salary of 20,000, paid salary to the extent of 20,000 per month. And this is an accounting period, 1 year. So therefore, the salary will be 240,000 expense and the payment. Then the next transaction is the charges for using the website hosting. The charges for using the website hosting is 100,000 paid during the period. Otherwise, to create a liability. So we assume that everything is paid as and when it is due. So hosting charges is an expense and cash outflow. Collection from the debtors, 80%, and the balance is treated as bad debt. Bad. So the collection from the debtors is a receipt, and collection is 80%. So therefore, 80% of the debtors received, and the balance is treated as a bad debt because the customer has become insolvent. So the balance 20% will be treated as a bad debt. It will be treated as a bad debt. Now, because of the collection and the bad debt, the debtors will become zero because of the collection and the bad debt. Okay, so opening debtors minus collection minus bad debt. Received dividend from Z Limited 20,000. Z shares are held by ABC. So they're receiving the dividend. It's an income and cash inflow. And during this period, because the company is sitting in a huge amount of cash, so they paid off a loan on 31st March 2020, a loan of 8%, 300,000. But before that, it is better to pay the interest because of the accrual principle and matching principle for the entire year, because the loan has been paid off only at the end of the year. So therefore, payment of interest and payment of loan is a cash outflow. Interest is an expense, and the reduction of loan is will lead to the 8% loan will no more appear on the balance sheet. Wonderful. And now see, one of the promoters has decided to sell 5,000 shares in the company at a premium of 150,000 to another outsider at 150, and use the funds to start another e-commerce business with a focus on the medical equipment, medical services. But this is a transaction between C and D. ABC is no way connected because of the business entity concept. This will not be having any effect on the financial statements of ABC. Now, since all transactions are done, let us see the charge depreciation, because depreciation is an expense as per the matching principle, and the depreciation is a change in the accumulated depreciation which is there on the balance sheet. The depreciation, accumulated depreciation changes because of the depreciation of the current period. Similarly, the amortization is also an expense. Amortization of copyright, depreciation of computer. So because of that depreciation, the accumulated depreciation will increase to the extent of 250, and accumulated amortization will increase to the extent of 50,000. No other transaction. So let us find profit. Profit is equal to incomes minus the expenses. So profit before tax is incomes minus expenses. So which is 507,200, and tax 25%, tax 25%. Because we have sufficient cash, let us pay the tax. So profit before tax minus tax is PBT. So profit after tax is 380,000, and the company declares a dividend of 40%, the company declares dividend of 40%, and 40% is calculated on the capital. So by default definition of dividend, this dividend is always calculated either per share or on the face value or the nominal value of the capital. So because of the distribution of dividend, the retained profit reduces to that extent. We can see the retained profit, opening retained profit plus the PAT minus the dividend is the closing retained profit. So profit transferred to the balance sheet and cash transferred to the cash and the balance sheet. So the totals of receipts minus payment is cash in hand, and cash in hand is transferred to the balance sheet. So balance sheet is now required to be closed. No change in the interest payable. That means we assume that this has not been paid. And so the summation of sources should be equal to the summation of assets. No change in the shares, no change in the copyright, no change in the computers. So the summation of the sources is equal to the summation of assets. So the balance sheet also tallies. But because of these transactions, let us see what has happened to the book value per share. The book value per share has changed. That is now 43.101. The increase in the book value is partly because of the change in the number of shares, because the shares were issued at the book value, and also the retention of some amount of change in the profit. So the business is reasonably doing well because of the increased retention of profit and increase in equity. And the individual shareholders, some of them have converted their profits into cash and diverted into some other businesses. So therefore, once the transactions are given, it is possible to observe the impact of those decisions on the financial statements. Thank you very much.